accounts receivable has already shown net. All we're doing is increasing the allowance, decreasing the accounts receivable. Net, at net, that's still zero. We're not doing anything to the accounts receivable balance. All we're doing is removing that customer receivable from our gross balance, right? From our gross balance, and you'll see that makes sense when we get into sort of a percent to our AR aging bucket. It'll make sense why that gross receivable, we want to reduce it, we want to get rid of it. So really, we're not affecting the net balance with number 2, we're only affecting the gross balance of accounts receivable. But since accounts receivable is shown net on the balance sheet anyway, it doesn't really affect how it shows up on the balance sheet. That may be too complicated, you may need to go back and watch this lesson again. By all means do so, but important concept to know, and you may see it in one of your homework problems. Number 3. Entry to record collection of previously written off amounts. Okay, so say, as we did in number 2, we wanted to forget about this. We said, we're never going to receive this from this guy. He's a deadbeat, never going to get that money back from my friend. Just write it off. I want to forget about it. Well, all of a sudden he surprises us and he pays us. Oh, so what do? Okay, well, we have to reverse the previous journal entry that we posted up here, where we debited allowance for doubtful accounts, credit accounts receivable. So let's reverse that. Debit accounts receivable, credit allowance for doubtful accounts, and then we receive the cash. So let's debit the cash, and then we're no longer owed that money, so let's decrease accounts receivable. Now, this entry may seem redundant, may seem stupid. Well, it probably is, but whatever. You need to know it because it could show up on your homework. Just rewind this, understand the concept, go back. If you see it in your homework problem, oh, I know that. That's that stupid journal entry where we reverse the previous entry and then record it, but we reduce the accounts receivable. I don't get it, whatever. But here's the mechanics of it. Understand the mechanics, you'll be able to pass your exam. Number 4, the percent estimated uncollectible. In the current year, Roundbelly had credit sales. So credit sales, we're extending credit, right? There's a cost associated with extending credit. Bad debts associated with extending credit. Okay. Percent estimated uncollectible. In the current year, Roundbelly had credit sales of 1,567,632. Past experience indicates that bad debts are 1/4% of sales. Remember when up here I said percentage of credit sales, that bad debt percentage is based on actual uncollectible from prior years? Okay, so we're given an actual. You always have to be given the actual on this to come up with a calculation. Otherwise, you wouldn't know. You can't come up with it yourself. You don't know what the historical actual is. So that's always going to be a given. The historical actual is 1/4%. Look over here to the right. I have the formula. Net credit sales times percent estimated uncollectible equals your bad debt expense. Okay, well, that's the formula. Let's put in the numbers. Here's our net credit sales. It's a given. Our percent estimated uncollectible, that's a given. The amount of our bad debt expense, the amount that's going in the journal entry, is just calculation. It's 3,919. We're going to increase the, remember this is an accrual entry, so we're going to increase the asset, increase the liability, but this is not really a liability, it's a contra asset, but it's the same thing, right? Debit bad debt expense, credit allowance for doubtful accounts, 3,919. That's how you record the journal entry for bad debt. That looks similar to 1, but we went through the calculation and then we recorded that amount. Moving on to 5, aging of accounts receivable. Using the aging down below, it's given right here at the bottom. Using the aging schedule, prepare the journal entry based on Roundbelly's policy of uncollectible by aging bucket. Roundbelly's policy, how do I know that? It's got to be a given. The policy has to be a given. It's going to be included in your homework problem. It's going to be in the test problem. The policy has to be given, all right? So what's the policy? You'll come down here. Percent uncollectible. It's divided by buckets. 0 to 30, 30 to 60, 60 to 90, over 90. Look at that line that says percent uncollectible. It's highlighted in that reddish pink. All right, we're going to reserve 1% of the 0 to 30 bucket. We're going to reserve 4% of the 30 to 60 bucket. We're going to reserve 20% of the 60 to 90, and we're going to reserve 100% of the over 90. Okay, why do I do that? Well, it's a given. You do it because it's a given. Understand the mechanics of the problem, and you'll be able to answer it correctly. Conceptually, you may not understand it. Understand the mechanics, you'll be able to do the homework, be able to pass the exam, but the mechanics are a little quirky. Or, sorry, the concept's a little quirky, the mechanics are easy. Anyway, so we got Ferry Boat Co., Easy Yachting, Lehman Brothers. Lehman Brothers, they went bankrupt. We're probably not going to collect that, right? That's why it's in that old, and we're going to reserve 100% of it. These other guys, yeah, we got a good chance, but we're not 100% sure. Anyway, Once we multiply all those percentages by each other, we come up with a bad debt expense of $14,995. Journal entry, same as 4, same as 1. Debit bad debt expense, credit allowance for doubtful accounts. All right, now let's move on to 6. Recording a note receivable. On November 1st, 2009, Round Valley loaned $100,000 cash and accepted a $100,000 1-year 12% note. Interest is received upon maturity on October 31st, 2010. Okay, so those are the givens. What happens as soon as we issue the note? We got assets, resources going, and receiving something in exchange, right? It's a transaction. So what are the accounts? Well, cash went out the door. Let's credit cash. What do we get in exchange? Another asset, like a note receivable. They're going to pay us that. It's kind of like a receivable, but it's not an accounts receivable. It's a note receivable. All right, so let's debit that account. Now, December 31st. Say our year end, right? We're going to close. Accrual adjustment, right? We got to go through our closing entries. Go back to lesson 4. Period end, you got to go through all these accrual entries. And one of the unobservable events that we identified as accrual adjustment is our interest, right? We're earning interest on this note receivable. We need to record the interest. How do we do that? Well, it's a simple calculation. I didn't line it out here, but so we got 12% over a year, right? And how long? November 1st is when we issue the note. All right, so we got November and December, 2 months. All right, so 2 months divided by 12, we get to 1/6. 1/6 of 12%. I'm not sure how that math works out, but anyway, I've done it already. The interest that we received is $2,000. The interest revenue we're going to recognize is well, we didn't receive the interest yet. We're going to record an interest receivable, right? This is accrual entry. No cash has happened. Unobservable event. We don't know, but we need to record the accrual adjustment. Increase the receivable. Increase the revenue with credit, right? That's how we increase revenue, credit. Now. Next transaction, to record collection of loan and interest on maturity. Maturity is October 1st, 2010. So next year we're recording this entry. All right, so we've already, so we get the cash, right? We get the cash plus the interest. That's one, and so, well, how do we calculate interest? 12% for a year on 100,000, that's easy. 12% times 100,000 is $12,000, right? So they pay us the principal and the interest, $112,000. Debit cash, $112,000. Now we need to record all these other entries. All right, we had already recorded an interest receivable of $2,000 up above. All right, so that was a debit. We got the cash. Need to credit it. Also, what else? We would have recognized in the next year $10,000 of interest revenue for the remaining. We recorded $2,000 last year. $10,000 we would record this year. Credit interest revenue, right? Revenue up. Note receivable. We receive the cash, just like when we receive accounts receivable. We had a debit on the books as an asset. Well, then we get the cash. We credit. We're no longer owed that. It's credit accounts. Credit note receivable. Now, quickly, I'm going to go through gross versus net for AR. All right. Accounts receivable. The gross balance is the top line item. $500,000. $500. Before the write-off. After the write-off, $470. Remember when I said number 2, gross versus net? It's the same thing when you write something off. Well, here's why. If we make the entry from number 1, here before write-off, we say the allowance is $50 and our accounts receivable is $500, so we're left with $450. Now we book that write-off, so we reduce the gross, but we're also reducing the allowance for doubtful accounts. Remember, right here we credit it to increase it. Here we're debiting it to decrease it. So if we decrease it by 30, we also decrease the receivable by 30. We come to 450. It's the same answer. Same answer. Like I said, it doesn't make a difference when you write something off because you've already recorded the expense. If that doesn't make sense, go back and watch the lesson again. Now I'm going to get back into the ratios. Common financial ratios relating to accounts receivable. All right, I'm not going to go through the calculations. It's all here. The information is taken from this same problem, so you can see how it all flows. But, I'm sorry, it's not taken from this problem. It's all just given. Similar if it's in your homework, if it's in your exam, they're going to give you the information, or you're just going to take it from the income statement. But Lesson 13 covers that more in depth. I'm including it here just in case you do have a homework problem about a specific accounts receivable financial ratio. Anyway, real quickly, I'm just going to tell you what these mean, and then that's all you really need to know besides the calculation. Calculation is pretty straightforward. It's just simple calculation. Receivables turnover ratio. That tells you how fast you're collecting your accounts receivable. The higher, the better. That tells you how long it takes your customer to sell a product then to receive the cash, then to pay you, right? The faster the better. The more cash you're getting, the better it is for you. The higher that number, the better. Similar to the days to collect, if you look at the calculation, you take 365 divided by your turnover. So the smaller that number, the better, because that means it takes less time for you to collect the money. So you want a higher turnover, lower days outstanding. That's basically the concepts behind the common AR ratios. Thank you.